Welcome. This is Mary Ellen McGonagle with the MEM Edge Show, brought to you each and every Friday, 5 p.m. And we are going to, as always, take a look at the markets. There are definite themes that have been emerging and they are beginning to materialize even further. So we're going to review that as well as quite a bit of other action that is going on in the markets. And I did want to say welcome from New York City. I flew from Los Angeles here last evening, and a lot of people want to know, how were the airports? Was the flight crowded? And interestingly enough, the flight was fully booked, for the most part. Airport, not one individual wearing a face mask. Likewise on the airplane. So I think people are, I'm sure it's going to depend on where you go and who you traffic with. But for the most part, went to a restaurant in Manhattan, fully crowded today. So it gets tough when you're an investor and you pay close attention to those broader markets. It can really kind of curb your thinking a bit. So it's been interesting for me to get out of my little research head and see how the bigger picture, the rest of the broader population may not be quite as panicked as those on Wall Street. So just a little sidebar there. Let's go ahead and get started. I'll share with you what we are going to be reviewing today. As always, we are going to take a super close look at the broader markets. Where are we now? I'll show a little bit in the way of historical precedent to help give you a game plan. As always, we want to be prepared going into the next weeks, and certainly in this current rather chaotic feeling market environment. So we're going to drill down and look at the markets. Also, stocks that are benefiting from the coronavirus. So I mentioned in the beginning, there are some themes that have been materializing, but they are beginning to really firm up even further. And that is stocks, and you even hate to use that word benefiting, but I think what I'm really trying to say here is stocks that are going to fare well because of this global epidemic that is taking hold. And one area, of course, we're going to take a look at is the concept of telecommuting. And there are definite pockets of strength in that area as more and more companies, very well-known names, are beginning to promote working from home and closing their offices. And then another big move from the coronavirus is among these medical stocks. It's not just biotech. Some of these bigger medical companies are also looking fairly constructive. I do have to frame that, but these are companies, either they have diagnostic products that are in the pipeline or close to formulating actual drugs. And then drugs in general are really firming up, but you'll get a case for all of that as we move on. Another phenomenon that we did see this week is a lot in the way of bottom fishing. A lot of investors thinking that maybe travel stocks were overdone to the downside. We'll get into that as well today. Also seeking safe haven yield stocks. There are actually three distinct areas with higher yields that are most definitely outperforming the markets, so you'll want to be aware of that. And then looking longer term to provide a different perspective. And I think this might help, again, potentially quell or calm those that may be really quite unnerved by the current market environment, particularly if you're looking at daily price charts. The volatility has been rather tremendous, so it can be really off-putting. I think what you'll find is if you have stocks that you've held for a while and you are interested in not necessarily selling, you'll want to look at a longer term chart. So I'll share with you that perspective. So give you just a little bit of a view within not only the markets, but also for your individual stocks. So let's go ahead and get started. I'm going to exit out of here because what we want to do is, of course, take a look at the S&P 500. So I'm going to take us right to this broader market indice chart. And this first view that I am sharing with you is a weekly chart of the S&P 500. And so I really wanted to give you a sense of where we are now on this weekly. This is just that huge historic break that did occur last week. And we're taking a look here on each bar. Again, is going to be each week, it's going to be 1 week of trading activity. And so this red line is your 10-week, better known as your 50-day simple moving average. The blue line is your 40-week or 200-day simple moving average. And both of these are very widely used simple moving average metrics institutionally, which is why I tend to favor them. I know that they are being widely watched by the big guns, those with the big money. So we can see, of course, last week we had that break below not only the 50 and the 200-day simple moving average, tremendous volume. But this week we managed to break up back above that 200-day simple moving average. A little bit of bullish action. I'm going to share with you which groups those were that were driving us back up a bit above that 200. But of course, the more recent action, we managed to close the week down below that 200-day simple moving average, and we were up a little bit on the S&P, almost a little over a half of a percentage point. And as we move on, I will share with you those stocks that are helping to keep the S&P certainly not from deteriorating even below last week's low. But let's go back, take a look at history. What I've done is put these lines here that are really telling, and they're taking us back to other very difficult periods in the markets. Now, I've heard comparisons, the current environment, to the beginning of 2018 when we first started to see deterioration. And that was primarily because at the end of 2017 going into 2018, we had a number of stocks that were reaching excessive multiples. There was quite the run up, a lot of FANG stocks hitting new highs. So we did get this corrective phase, but I would argue it's not quite as relative as our current environment simply because it found support at its upward trending 200-day simple moving average before emerging back out, taking us over to this bear market period at the end of 2018, just not because it was a bear market, but just because of characteristics might be a little more telling or useful. So let's key in on some of the action that occurred back last, the fall of 2018, when we did see the S&P break down. I am also pointing out to you that the RSI, that's a relative strength indicator, turned negative in line with the break below that 50, and then evidently or eventually below that 200. And let's take a look at the bottom. I have another momentum indicator. These are stochastics. And with stochastics, you're paying attention to crossovers, the black line either down or up through the red signal line, but also the position of those stochastics relative to this 50. That's your neutral line, if you will. So taking us back to that last fall period, we can see that we did have that price break with the RSI and the stochastics turning negative. So let's fast forward, see where we are currently. And so we are in that rather similar phase just right now. And so what you can do as far as what your prognosis or what we can look forward to as far as the markets emerging out of this downtrending period, what we want to pay attention to is the fact that we've had going back to that fall 18 period, we had these bumpy kind of back and fill on a daily. You'll see it was a little bit more violent, if you will. But throughout this period, we can see that the RSI, unfortunately, did not turn positive again. Likewise with the stochastics, they did come out of this oversold period, but it was not until we entered that very end period of December into January that we did get this break positively back on the RSI above this net neutral. And then also we had the price break above these simple moving averages and your stochastics moving back up. So this is what we're going to be on the prowl for on the bullish side. And we can see we don't necessarily have to have this type of a steep drop before we have a recovery phase. And I would take us back to the end of 2015 into 2016. I remember this period quite well, where we broke down not only on the stochastics, but also on the RSI. Really, it was a matter of about 4 weeks before we did get that positive break back up. But more to the point today is to have you aware of what we'll want to be on the lookout for a reversal of this current corrective phase that we are in. Now, let's take another look at the markets. What we want to do from here is go ahead and take a look at the sectors within the S&P 500 to get a sense of where we may be experiencing some pockets of strength. And so what I've gone ahead here on this candle glance view, available to you from that front page of StockCharts.com. This is a 2-month daily price chart of each of the 11 sectors in the S&P 500. And I've gone ahead and overlaid an RSI. I want to see where that relative strength is, sorted it descending order. So from left, upper left is your strongest current area. And then drilling down to energy, of course, very weak in this current environment, down even almost 6% today. But up here in the forefront, we can see rather clearly it is all about defensive groups. We can see utilities, staples, healthcare, and real estates led by these higher yielding REIT stocks are up here in the forefront. So that's where, for those of you that are looking to potentially buffer your any other holdings outside of defensive areas, where we can start to drill down. And what I'm going to do is share with you pockets of strength within each of these sectors, explain to you why there's strength there. There are actually sound fundamental reasons. For those of you, again, that are potentially would like to get some higher yielding names that could outstand these market downward pressures. And then interestingly, I find this very constructive, the fact that technology is up here more in the forefront, certainly, than communications. Financials are continuing to get walloped with this low interest rate environment. But technology stocks this week actually were only down 0.6% for the week. That's constructive. And there are areas within tech. Now, some of them are going to be that telecommuting related, but we're going to take a look at some bigger names in tech that are holding in relatively well. We'll say that. So that's your sector view. From here, of course, we want to take a look at some of the other industry groupings within the broader markets, not just that S&P 500. Same 2-month daily view, thumbnail shot here, RSI in descending order. And what I have here is not only the S&P, but also the NASDAQ, the Dow is here, as well as the small cap Russell 2000 index. We have gold, semiconductors, and then TNX is going to be the yield on your 10-year treasury. So again, taking a look, volatility is super high. I'm going to go ahead and blow some of these up to give you more perspective. That can be quite helpful. This is a daily chart of the volatility index. As you may recall from last week's show, we were very alarmed that it got up as high as 50. So from here, we are going to take it out a little bit further to give you perspective, because this week we got up almost as high as 55%. So this is where history can be telling. I talked to you about other periods of the market that went into a correction and were difficult. This is that 2018 period where we were viewing the S&P and comparing it to current levels. And we can see at that peak, it did only get up to 50. I also talked to you about that 2015-2016 period, and we did get up almost to that 55. So really, the VIX is at, again, we ended last week in a similar period where the VIX is almost in a little bit of a buy signal, in the sense that we are peaking. You'd really have to go back to this the banking collapse back in 08 and 09 to reach levels that spiked over 80. but just taking a look at current history. So that's your VIX. Let's go back and take a look at some of these other underlying various industry groups within the broader markets. And gold certainly has been rather stellar as a safe haven proxy. Also, the weakness in the dollar is driving demand in gold. So we're seeing gold stocks hitting a new high. So that certainly can be a vibrant area as a way to defend your other holdings. Biotech stocks, we talked about this strength. Biotech stocks this week were actually down just very little for the week. So this particular group, we are seeing vibrancy, of course, not only among the coronavirus related biotech stocks, but I also wanted to point out that when I look at groups in the markets, I'm really going to drill down very, very much to see what is the driver. And I will tell you, some of the top performers among biotech are oncology, cancer related stocks. It's not all about coronavirus. The science here is that demand for these cancer related drugs will remain very firmly in place, regardless of any potential economic downfall. So then from here, we can see some of these other groups, transport still down and out. Of course, they're going to be impacted by potential lower travel, certainly leisure travel. And so we can see the 10-year yield actually hitting a low. It's down below, I believe it's at about 0.7%, really significant decline here on these treasuries today in quite a bit today, as a matter of fact. So those are the underlying groups. What I'm going to do now is just take a quick break. And when we get back, we are going to focus on those pockets of strength and show you areas that you could potentially capitalize on that strength. So we will be right back. Welcome back. What I did want to do is share with you ways that you can get on top of where there are, again, pockets of strength, areas within the market that are relatively withstanding the downward pressure. So let's take a look. What we're looking at here is called a Scooter report, SCTR. And that actually stands for StockCharts technical rating. And the higher the rating, the better. It's telling you that that has a constructive looking chart. So what we can do from here is then go ahead and take a look at these Scooter reports in any given market cap, industries, or certainly ETFs. And that's what I did want to begin with, taking you to this view of what ETFs are really outperforming. So when it has a 99, I'm just going to go ahead and hover, and you can see hopefully the thumbnail view of the underlying chart, and we can see really explosive moves underlying it. So let's just take a quick look. I think you'll be able to see very clearly where the strength is. A lot of these are going to be the VIX related. We talked about the big move of the VIX up to that 50 level. Let's go ahead down, and there are some interesting areas that, for me, you might not think about. Solar ETFs, so alternative energy, is actually an interesting area that is still holding up. And then, of course, from here, as we drill down, you're going to see an awful lot of these US bond ETFs, treasuries, municipals, and so forth, followed by biotechs. And the reason I'm pointing these out is for those of you that are not inclined to look at individual stocks, you can take a look at some of these ETFs, not just from a potential investment standpoint, but also to very quickly get your arms around where the strength is. Let's go ahead over to large cap stocks. This is also going to be really quite telling. Biotech, Regeneron, this company was one of the first to, back in January, they came out and said that they had they were on track to provide a cure. Take a look at this significant uptrend. Now this actually, with my work, I have my MEM Edge biweekly report, which has been almost a daily report given the volatility these days. But this was a stock that had been on our list. We picked it up last fall. It was performing really quite well. And surprisingly, despite their coronavirus affiliation, they fell right out of bed at the end of January. But let's take a look at this vibrancy here more recently, where the stock has broken back up above the simple moving average, finding support at this upward trending 10-day, that's your green line. And we can see the stock on the RSI is overbought, but it can remain overbought and you'll still be in good standing. So there are any number of very fast-moving coronavirus-related stocks. And for those of you that have an appetite and you are nimble in the markets, I would urge you to take a look at a intraday chart to help you out. This is a 60-minute price chart of Regeneron, and we can see that this is that break back up above. I have a 5 and an 8-hour simple moving average. So you could potentially play this trend. It looks to have broken back up above it at the close today. You do want to marry that with a positive MACD and RSI. So that is large cap. Let's take a look at some of the other large cap stocks. It's already sorted for you by strength. And we can see Newmont certainly in gold. Now, this is very interesting to me that these semiconductor stocks are up in the forefront. Their thumbnail chart will tell you that they had a little bit of a tough go this week. But more to my point is I'm going to pay very close attention to non-defensive groups that are holding up well. And this is with an eye toward when the markets turn. These stocks that are, again, not defensive by nature, that are holding up well, are going to be your leadership names. So we have a couple of software. And then outside of that, we can see some of these utility stocks and so forth. So that was a view I did want to go ahead and share with you. From here, let's go ahead and take a look at the sector for this week. As you know, I like to take a weekend view of the markets, and we can see really explosive moves here. Utility stocks up 8%, consumer staples 6%, and then healthcare and so on. What I did want to share with you, in fact, I can very quickly show you a group chart, is the fact that utility stocks were down almost the most last week. They were down 10%, more than the broader markets last week. That was an unusual, just very, very disruptive move in the utilities. But this bullish move on last Friday, when the utility index broke below this 200-day simple moving average, huge volume. Buyers came in on the dip, closed the day on the upper portion of its trading range. So that's a very bullish candlestick pattern. And then from here, we can see this very nice recovery attempt, almost a V-shaped recovery. Let's get into utilities and take a look at some of the stocks. There are dynamics here that I wanted to share with you. Certainly, we can take a look at conventional electricity. And as you know, we will need electricity regardless of economic turmoil. And from here, we can go ahead and sort it by that StockCharts technical rating again. And a number of these top names up here I am very, very familiar with. A couple of them are on our MEM Edge list, and they have dynamics unique to them. And one, of course, is that they are in an area, they are servicing an area of the US that is in a growth mode. And that could be certainly North and South Carolina. Florida is far and away. That's next era, big growth area. And then even if you know your regional areas, there are some areas that impact. I'm from the Southern California area, and there are growth areas there. But there are other characteristics as well that will drive these stocks up. And they also provide you that nice yield. We can take a quick look at NEE as an example. This is that sharp drop last week, V-shaped. It actually hit a new high this week, but pulled back very orderly to that 10-day simple moving average, another bullish candle on the Friday close. So that's what we want to see. Let's take a look at some of these other defensive sectors, and I'll share some insights as to the strength there and precisely why. Consumer staples, now this, we can look at the chart. It really sat out Most of the increase that you saw in some of these other areas, another group that really fell out of bed, even more than utilities last week, and attempting to recover. But we can take a look at some themes among the staples that I found really kind of interesting. One, of course, this is kind of makes sense as you, any of you that read any kind of headlines will be aware of the hoarding that people are doing. Individuals are going to these markets and stocking up on goods from toilet paper to water. This is Kroger, KR. In addition, Kroger just came out with strong numbers, but we can see this big move upward that is being experienced among some of these retail stocks. Not all of them. I'll tell you, you're going to have to sort it by scooter because some of these are up, but their charts are not particularly attractive. So consumer staples, also we have non-durable household products among staples. Kimberly-Clark, these guys are big paper product providers, diapers among them, and I've heard from other parents they're hoarding, cannot do without diapers if you have children. So that's one of their big, and they have other paper products as well. But we can see how the stock is again having this nice V-shaped recovery with positive MACD and RSI. Clorox was an early mover. These guys, the concept of the need for antibiotics, or pardon me, for ways that you can clean surfaces of any potential virus. So it's been a bit volatile. It's not something I would particularly traffic in, but certainly worth noting. So that is the consumer staple. I did want to make sure we had time to get into healthcare so I can really share with you some of the pockets. Now, it's not always that healthcare is viewed as defensive, but it certainly is coming into play in this current environment. Healthcare providers, those of you that, again, follow the headlines will know this is all about Super Tuesday, Biden's win, and the sense that we could see that Bernie Sanders, had he been the winner, we would not see this significant move into these healthcare providers. But let's move beyond that because healthcare providers are such a hot button politically. I can see they've had big moves. I would rather go with a stock that has more sound reasonings behind its uptrending period. So we're looking at the healthcare sector overall. And I've done a lot of work in this area in the sense that I know that this is one of the forefront runners as far as developing a vaccine, mRNA. But also, so we can see this actually is a very, very attractive chart. We can see the RSI, MACD is positive. The stock is really base building after this significant, I believe it was a 43% uptick there, but it's digesting that move, finding support at an upward trending 10-day simple moving average. But one metric or item I did want to share with you that I pointed out before is, for instance, RCUS. A number of these other drugs are actually cancer related, whether it's oncology, whether they've actually developed or are in the throes of doing just that. I know I won't have time, but I do have a handful of some of these biotech stocks that are better positioned than others to actually formulate. They already have vaccines in place. This is INO. I'm actually not adding value. That's up 43% today. But let's go ahead back and take a look at one other area that we mentioned is defensive and is really holding in quite well, and that is your real estate stocks. These are going to be primarily REITs. And this is another area where you will see themes emerge within the underlying areas. And really, it is, if you were to drill down and take it further, you'll see these themes have real reasonings behind them as far as why they are doing well. We can take a look at HTA. This is one of many. MPW. This theme has everything to do with healthcare. The REITs own and manage healthcare buildings, And HTA, as an example, is having this nice V-shaped recovery. And what is happening